In this discussion, we will discuss the discussion question of explain the calculation of break-even time and how it is used. When we see a discussion question or essay question such as this, our goal typically is to expand on the discussion or essay question to be more likely that we pick up as many points as possible. With an essay question, we're more likely to touch on those topics that are being required within the essay question. And for a discussion question, the goal typically is to add new information to the discussion. Expanding on the discussion question then is a way to do that. Keeping that in mind, let's go through this one more time. Explain the calculation of break-even time and how it is used. So first starting point often will be with the break-even time is let's define the break-even time. But we could take a step back from there and we could say, well, when is the break-even time usually used? Usually within a capital budgeting type decision. And we could even take a step back from there and say, well, capital budgeting decision is usually a managerial decision as opposed to financial decision. So we could take a step back if we need to expand in something like a discussion question and say, well, managerial accounting decisions are going to be internal decisions on what we should do, as opposed to financial accounting decisions, which are usually based on how we should record something, how to put the data together to create the financial statements. And then we can go into the break-even time, what it's used for, capital budgeting type decisions typically. What are capital budgeting type decisions? Usually they involve an initial cash outflow, and they're going to then have a return on the investment inflows in the future that we're going to have to figure out whether or not it'll be a good thing to do or not to invest in a capital project. Capital project decisions then are going to be a bit more risky. They are going to be longer into the future, and we then often think about the concept of time value of money. So then we could discuss, well, what is time value of money? Typically the concept being that the money today is going to be worth more than money in the future. So if we get the same amount of money in the future as we get today, the future money is typically worth less, and we consider that because of a few different factors. We can consider the fact that the purchasing power actually goes down, and therefore the dollars are worth less in that they can't purchase as many items in the future for the same dollar amount. And we could think a bit about opportunity cost. If we had the dollar today, we could invest that dollar somewhere else, or we can purchase something, we could get use out of it at this point in time. Given those, then we could say, well, the break-even time is going to be something that it will allow us to evaluate capital projects. That's going to be one method that we can use to evaluate the capital projects. It does take into consideration and use time value of money. So the break-even time is going to be very similar to the payback period. The payback period being a fairly simplified type of calculation that's useful to use, but doesn't take into account the time value of money. So the payback period just basically says, here's our initial investment. How long will it take until we get our money back, not considering time value of money? How long will it take before our cash inflows are equivalent to the initial cash outflow that we made at the beginning of the project? So that's going to be the payback period. The break-even time then, taking into consideration the time value of money, will then say, okay, here's our initial cash outflow, here's our cash inflows, let's present value those cash inflows. So first we'll present value those cash inflows, we'll bring them back to current dollar amounts using some type of discount rate. And we could consider, what types of discount rates too. You could expand on how you would consider what discount rate to use. But in essence, we're going to use some type of discount rate. We're going to get the present value of the cash flows as opposed to simply the dollar amount of the cash flows. And then we'll apply the similar type of calculation for the payback period, but now using present value dollars. So we're saying here's the initial cash outlay. Here's us receiving cash in the future from the project, but now present valuing those cash flows. And now we look for that time period at which it breaks even, at which those two items are breaking even. So the benefit of this is, of course, that we take into consideration the time value of money to consider when we're going to get basically paid back instead of just taking the cash flows. One of the problems with this type of calculation is although it takes in the time value of money, it still doesn't account for the items that are going to happen past the point in time that we get paid back. This is just basically saying this is when we break even. This is when we get paid back. However, it doesn't consider the fact that after that point in time, we could have a lot of investments, a lot of money that we're going to be receiving after that point in time. And so it doesn't really measure the value of the investment in terms of the return on the investment. And so for that, we would have to use other methods, but give us a good method to check on like the risk of the investment. How long does it take before we get our money back?